Gromen, FFTT. Hope you are well and having a great week so far. Getting into the tail end of summer now. We're starting to get some of these fall clouds off of Lake Erie, a little bit of cooler nights, great sleeping weather. So, hope you're enjoying the last days of summer. I'm going to jump right in. As always, thank you for the questions. First question is from Tom. When does the bond market begin saying no mas? The question reminds me of a great quote, one of my favorite quotes from former Nike CEO Phil Knight, who around the year 2000 said everyone was looking for the next Michael Jordan on the basketball court, but he was walking up the fairway, obviously referring to Tiger Woods. In this same way, I see a lot of analysts, economists, policymakers, etc., looking for the next bond market refusal or rebuttal or problem as a result of the U.S. fiscal situation at the long end of the Treasury curve. I don't think that's the right place to look. The right place to look is walking up the fairway, which is to say in 2022, when gold separated from inverted 10-year real rates, that was the bond market saying no mas. And there have been games played since in terms of shifting issuance around, etc. In the end, the bond market saying no mas wasn't the bond market doing it. It was the bond market of 0% coupons, infinite duration, and finite issuance saying no mas. It was gold said no mas in the fall of 2022 when it separated from U.S. real rates. What's the message of that? It's simple. If the U.S. tries to cut spending to fix the fiscal problem, they will drive receipts down below true interest expense, and they will either have to default on entitlements or interest or have to print the difference. All good for gold. Alternatively, if they just keep inflating to try to keep growth far enough above rates to keep the fiscal situation sustainable, that's negative real interest rates. That's great for gold too. And that's why gold separated from real rates in 2022. And that was when the bond market said no mas. It's just everyone's looking for the bond market to say no mas. It was the gold market, the bond market of 0% coupon, infinite duration, and finite issuance. Next question from Gary. What is the bear case for gold right now? I heard Andreas Steno recently say he thought it could drop with the dollar due to Chinese buying more gold as the dollar was rising. Do you agree? Thanks. I don't agree. In my opinion, the bear case on gold is pretty straightforward. It ties into the point I just made, which is the bear case on gold is the U.S. government slashes spending on entitlements and on defense to make room for interest payments to China et al. That's the initial bear case. That would be, I would sell gold. If the U.S. government came out and said, we are cutting entitlement spending by 20-30% immediately, and we are cutting defense spending by 20-30% immediately, China and Russia can divide up Eurasia as they see fit. I actually probably sell gold on that. Now, just for a moment. Because ultimately, for me to continue to be bearish on gold, I would have to need to see U.S. policymakers then stand aside through the geopolitical implications of that. I would need them to stand aside as their cuts to spending drove mathematically, with mathematical certainty, a decline in U.S. GDP into debt to GDP at 122% that would likely cause what would look and feel like Great Depression 2.0, as U.S. interest rates actually probably rose in that recession due to insufficient global private sector balance sheet relative to the amount of deficits the U.S. would be throwing off and relative to treasury issuance the world would have trying to sell treasuries to defend their currencies against what would be a rising dollar. And then I would need to see the U.S. government stand aside as U.S. banks started to fail. No bailouts. No bailouts for depositors for anything over $250,000. Go get your money out. Now you got bank runs all over the country. You probably start to have treasury auctions start to fail, probably even before that. So if the government did all of that, then I think you could see gold crash. I think the odds of any of those things happening are somewhere between slim and none, and slim just left town. So That to me is the bear case on gold at this moment. So next question is from HG. Love your content, agree with almost all of it, and really the only part that isn't sitting with me is, well, it is almost too obvious or logical. Could you maybe steelman an alternative, or how they would rationalize taking another path out of this fiscal situation that is maybe not so obvious now or doesn't make logical sense to the U.S., but you see how they would rationalize and force us or force it to be the path, even though the best scenario is obvious to us and staring them in the face in terms of basically injecting more dollar liquidity / weakening the dollar. I think the easiest way to steelman my case is you can arrive at that. Let's take a look at the line items that are causing the fiscal problem. It's straightforward. It's entitlements, 70% of receipts. 70% of U.S. tax receipts are being spent on entitlements right now, just short of it. Interest, on a gross basis, another 25% of receipts, and then defense is around 18% of receipts. That's it. Those are the only three things big enough to cut. So let's look at how let's do a sensitivity analysis on those things. Well, if we hike taxes, that's going to cause a recession in all likelihood. Receipts actually go down, deficit goes up, not down. We can't do that. Okay. If we cut the deficit, if we cut rates, inflation goes up. That's what I think we're going to do anyway. So we'd have to cut entitlements or defense, which I just noted that if they did that in sufficient size, you're probably going to drive a severe recession, if not depression. Receipts are actually going to fall dramatically. Deficit's actually going to rise, not fall. That's not going to work. Okay. What else can we do? Well, obviously cutting entitlements is politically unpalatable, number one, but that leaves you really one other thing you can do. If you can't cut defense, you can't cut entitlements, you can't cut rates, then you either need to find some sort of productivity miracle for entitlements. In other words, there is some app or health miracle that basically costs the system nothing and allows it to take care of all these people much more cheaply. So your $3.3 trillion, $3.4 trillion per year that we are currently spending on entitlements drops dramatically. That's one way out. So maybe, I don't know, Super Ozempic that is free and is made out of water, or something that's very cheap, or some sort of app that really cuts out the amount of intensity with which silent generation and boomers need to visit their doctors, something like that. That's one potential way they could buy time for the fiscal problem. The other way is more straightforward, which is to say, if the sickest quorum, or if a quorum of the sickest recipients of that $3.4, $3.5 trillion in entitlements, who account for a disproportionate percentage of those entitlements, if they died quickly over the next 2 to 3 years, for whatever reason. I'm going to stop there because things start to get kind of dark, and I don't want any sort of crazy tinfoil hat stuff. But those are the ways you could do it, objectively as an analyst. I don't like thinking about it. I'm not hoping for it. But as I by virtue of what I do, I'm constantly trying to steelman my own cases. And those are the best two I've come up with. So, let's watch. From David, as the U.S. fiscal crisis worsens, the probability of invoking the gold revaluation option increases. Perhaps it'll never happen, or it'll take years, but can you provide your thoughts on who are the top 2 or 3 opponents of this option and why they would oppose it? Let's to quote the bank robber Willie Horton when he was, or excuse me, not Willie Horton, Willie Sutton. Willie Sutton was asked why he robs bank. He said, well, that's where the money's at, right? So who would oppose gold revaluation? Well, anyone who's got their hands on the printing press wouldn't like that so much, right? So certain Washington, D.C. interests, certain Wall Street interests would not like it at all. With that said, those same folks who would not like the gold revaluation over a weekend as a way of recapitalizing the U.S. sovereign balance sheet, those people's credibility are deteriorating by the quarter alongside the U.S. fiscal position. And ultimately, as we saw in 2020 and we saw in 2019 with the repo rate spike, and as we saw in 2008, there are no atheists in foxholes ultimately. So it probably will require some sort of crisis, but ultimately, failing some sort of productivity miracle, I think at some point something like that probably happens in terms of the gold revaluation. From Gail, if there was a revaluation of gold over a weekend, say 10x, what asset classes would be on your radar to switch away from your gold holdings? Farmland, hobby farm, lake houses. Farmland is attractive. It is a true inflation hedged bond, and it has a very low cost of carry. I think I've said before, about 10 years ago, I owned about a 100-acre farm as an investment property. I rented it to a friend of mine who was a third or fourth generation farmer. The cost, the taxes on 100 acres of farmland in Ohio, if I recall correctly, were about $600 or $800 per year on the whole 100 acres. Very low cost to carry. Why? Because if you jack up taxes on farmer, all you're going to do is jack up taxes on food, and that's a good way to get yourself voted out of office, as we're seeing that becoming a political issue this election cycle. The lake house side, I would be looking for things in areas with demographic growth and with that I could rent out, that I could cash flow when I'm not there. The reason for that is I'm a lake house guy anyway, number one. But number two, I think demand for lake houses across this country is rising and is going to continue to rise. And I think it will take share from oceanfront because the insurance on lakes is much less than the insurance cost to carry on anything next to the ocean. And I think that's likely to continue for years to come for a number of reasons. And then the final question is from Travis. Can you please discuss Craig Shapiro's question, my friend Craig Shapiro's question? When does the market narrative shift from U.S. dollar is weak equals buy risk assets to U.S. dollar is weak, sell risk assets as foreign capital goes home? It's a great question. It might be one of the most important questions to consider. It is the Fed's worst nightmare. It is an emerging market problem. And critically, a twin deficit country like the United States cannot have capital outflows for very long. There's only two ways out of it for the Fed, really. They either have to hike rates to really high levels, penal rates, in order to basically break the system to keep capital here. The problem with that strategy is that they can't do that, as I noted in my first point, because U.S. debt to GDP, government debt to GDP is too high. They can't raise rates that high credibly without basically bankrupting the U.S. government. They will send interest and entitlements way above receipts. They'll send interest above receipts, and now you've made the situation worse. Hiking rates to keep capital here with a debt to GDP as high as ours is would be like throwing gasoline on a fire. And that's how the Fed screwed up this time, because they were so dogmatic about maintaining their credibility on inflation. They should have let inflation go higher for longer for 2022, 2023, get debt to GDP down to 70, 60%, 80% of GDP. Then that would have given them the option of hiking rates if they needed to attract capital. They don't have that option now. They took that option away from themselves, which short-sighted, political. I understand why it happens. In the end, I don't care. I now know that's not an option. So what would their other option be? They'd have to print dollars, and they'd have to buy corporate bonds, and they'd have to buy corporate equities. That's what they would have to do, and in my opinion, that's what they would do, and they would let the dollar be the release valve, in which case you could get a very, very pro-cyclical decline in the dollar in that case. Not a lot of people think it's possible. I don't think it's likely, but I think it's absolutely possible, depending on how things go. And quite honestly, it might be why China and the U.S. just signed this financial stability agreement. Maybe it's kind of a, hey, let's let's stop swinging the dollar wrecking ball because, yeah, we hit you a few times, but we hit ourselves in the crotch a few times too. So we're going to stop doing that for a moment and try to stabilize things. Maybe this carry trade unwind of the yen a few weeks ago scared people a little bit in policy circles. So critically, the reason why I think the Fed would have to print dollars and buy corporate bonds and equities in that case is because U.S. policymakers since Bill Clinton have allowed the system to evolve such that, and this is critical, U.S. stocks back the Treasury market de facto by virtue of marginal consumer spending, marginal GDP growth, marginal tax receipts. They have to have stocks go up. I didn't make the rules. I just play by the ones they set, and these are the ones they painted themselves into a corner on. So that's it for tonight. As always, if you like these updates, check us out, FFTT-LLC.com, for more information about our Tree Rings product, 10 most interesting things, brief synopsis about what grabbed our attention about them, whether it's confirming a way we'd been thinking about the world or changing our mind about a way we had previously been thinking. Get a lot of great feedback on it, so check it out. And in the meantime, enjoy the rest of your week. Look forward to catching up with you soon. Take care, everybody.